Hi, all. My name is Jeff Hulett. I'm a decision confidence builder and I lead Personal Finance Reimagined, a decision making and financial education platform. I teach at James Madison University and have been in banking and finance most of my career. Every month, we tackle a different high impact decision and personal finance topic. This month is for robo-advisors. It's going to be all about robo-advisors. The idea is to help you create a consistent, repeatable decision process to help you make the best robo decisions or other important life decisions. So, up to this point, you've heard me discussing robo advisors. For example, what they are, how they fit into your broader investment strategy, how they compare with human wealth advisors, and how to make the best decisions among the robo alternatives. So, it's time for you to hear another voice. I'm super excited to talk with Barbara Friedberg today. Barbara is a robo-advisor expert and brings a great perspective and experience to robo-advising and personal finance broadly. Barbara is the CEO of Wealth Media. So Wealth Media is dedicated to bringing investing, financial education, and saving strategies to people of all walks of life. Barbara also leads a personal finance website under her name, as well as her YouTube channel. Barbara offers consumable personal finance content integrating cutting-edge fintech and financial research. Barbara's background also includes advanced finance-related academic degrees. She's a professional portfolio manager and the author of several books. Barbara, welcome. So glad that you can be here today.
Thank you, Jeff. It's my pleasure.
So I want to just start with a little bit more of a personal or background question, Barbara. And when I've had a chance to go through your YouTube videos, of course I just gave you the introduction. Your experience is amazing, but one of my first question is really about, so you could have gone a number of different directions with that incredible background. And quite frankly, I have a lot of friends that are professional money managers or wealth managers, CFP types, the people that are investment advisors, which your background seems perfectly suited for. But you went a little different direction. And with Wealth Media, could you talk a little bit about that? And really, what I'm wondering is your motivation. Why this direction, the Barbara Friedberg direction, versus that maybe a little bit safer, more traditional industry route of going towards wealth management?
Well, thanks for asking, Jeff. I started out with about 20 years as an investment portfolio manager. So I have been that route. And I was a stock picker and was converted in my MBA program to being really a fund investor. And at some point, I wanted to give back and just decided um, it's time to move on, do something that I feel can educate others and help them learn the basic money skills so that they can build wealth regardless of what their income is. So it was a transition for me and a lot of fun in the process.
Oh, that's wonderful. And you mentioned one thing, Barbara, if I can just drill into this a little bit, basic money skills. By the way, I completely agree. And to some degree, that's what we're doing at Personal Finance Reimagined also. What amazes me is when you say basic money skills, you might think, it's just a basic skill. Anybody can do it. It never ceases to amaze me. It, it's not always done. In fact, on average, it's not done properly. And it seems like a continual problem, right? Where people really struggle with really getting those basic money skills. Do you have a take on that? Why is it so hard? Or to me at least, why does it seems hard? Why do you think it's a challenge?
There's a couple of reasons. One is we live in a society where we are bombarded with images on our phones, on our social media, online, on television that are telling us we need to buy, spend in order to be valuable and worthy. And that is counterproductive if you engage in that excess buying, spending, taking on debt. You will thwart any opportunities you have to build wealth. And so that's one problem, is that there are external forces. And then there are the internal forces in that we just never had anyone, many people did not have a model or someone to tell them how to spend, how to save, and how to invest. It's not complicated, but if you don't know those basic things, then you are going to miss the opportunity to set yourself up for future financial success.
So, I, just kind of building on that a little bit, one of the things I think of, and some of the statistics that I look at, especially in the United States, is our extraordinary low savings rate compared to other countries. And I mean, it's just kind of it's to me, it's a general human challenge, but in particular, it seems like it's even more impactful in the United States. So, with our low savings rates, it seems like, and especially for younger people just starting out, I tend to think that big problem for people to create wealth is first and foremost a savings discipline challenge, right? So then once they do get that, then of course, when we're going to be talking about robo-advisors but to me, when I sort of look at sort of the order of operations, right? You get a paycheck, you figure out how to save part of it, and you save it, and then you move it from there, and it gets into your robo-advisor account or whichever investment accounts. So it's just sort of that simple. But it's not that simple, right? And I was just curious, just when you kind of drilled into how, and I'm just curious, and maybe more of a personal question for you is, when you were starting out, or when you see other people, maybe that maybe in your community, how do they build savings discipline, or how did you build savings discipline? I was wondering, or do you even have advice for others on how to build savings discipline?
I was blessed. My parents were raised and born during the Depression, and they carried that feeling with them throughout their life. My father was extremely poor. He started work when he was age 10. My mother came from a rather middle class family, but not wealthy in any stretch of the imagination. So from the time I could listen, talk, I was trained in the mindset of sensible money matters. That means whenever you got any money, whether it's the 50 cents allowance that I got initially in elementary school to the 50 cents an hour I received for babysitting when I was in high school, I was taught a portion of that money goes into savings. A portion of it goes to charity, and the rest I can spend. So I have carried that discipline throughout my entire life. There has never, when I had my first job out of college, I remember I went to the bank with one of my coworkers. Now I put my entire check into the bank. She took her entire check out in cash. I was
Wow.
astonished by that. I
I can
thought,
imagine.
you're going to spend all your money? Where is the money that you're going to save for your rent, for your entertainment, for your savings account? So the most important thing you can do starting today is just develop a plan for having part of your paycheck automatically transferred into savings and investing accounts. If you do that and you don't take on any debt, but you spend what is less, you have created a livable budget and you have begun to set yourself up to have a financially secure life for not only now, but the future. But that's not easy. And I say that with a lot of empathy because it requires for some people, really a change in mindset and a change in habit.
Right. Well, Barbara, hearing about your parents, right? The Depression era parents, but it kind of makes me think of, while it wasn't fortunate that your parents went through the Depression, it was very fortunate that they, sort of passed on that discipline to you. Some of it intentional, probably some of it just because it's how they lived and it made sense for the time. I do I worry sometimes almost as much about, young people and perhaps who didn't have parents for whatever reason that really reinforced that. So there was no, Barbara Friedberg parents that were, all about, savings and reinforcing that, hammering that away. And, um, one of the words you used is automating, right? Automation. And sometimes I even think of that as while it's not a substitute for being, having parents or being brought up with a certain discipline, but it's a way to reinforce a habit that is good without having to remember to do the habit, right? Because if it's
Exactly.
automated, it happens and you don't have to make a conscious decision, right? And so, anyway, I
Well,
love
that
that.
is the one piece of advice. If the listeners take anything away from this interview, it is take part of your paycheck, and you can do this through your 401k at work. You can do this through your 401k and a bank savings account where you're funding an emergency fund. So it's not necessarily automated only to one place, but you want to think about automating some of your money for investing for the future for retirement, then some of it for intermediate goals like for your child's college spending, some
Right,
of it into an emergency account. So if your washing machine breaks, you have some cash to pay for it.
right. Well, good. So switching gears a little, Barbara, and moving from kind of the savings mindset to now into robo-advisors. And I've had a chance to watch several of your videos, and I love what you're doing with your YouTube channel. It's fabulous, deep, broad, lots of different topics, but certainly robo-advisors is one of the big focus areas, which has been really great for me to walk through, and I'm sure other folks would get value from it too. But you mentioned one of your videos is all about robos for beginners. So I was just wondering, when you think about not necessarily naming robos in particular at this point, but just more, what are some of the big differences between robo-advisors or for beginners? And if you were trying to give advice in terms of what are some of the key things that you would want to make sure a beginner's robo does, what would that be? And by the way, you've already mentioned automation, so I'm sure that'll be on the list. But I'm just thinking of other things that would be helpful around robo-advisors.
Sure. Well, first of all, for those of you that may not know what a robo-advisor is, let me just give you a quick drill down. And a robo-advisor is a financial advisor that invests for you using computerized algorithms. So they ask you a few questions about your age, your goals, your timeline, how comfortable you are with risk, and they come up with a profile for you that tries to encompass your answers. And the cool thing about every robo advisor that I have researched is you can adjust the balance of stocks and bonds within that. And those are the investments within it to better suit what you perceive as your risk comfort level. So that's really what a robo-advisor is. There, I would say in the US, there are probably 20, 25 major robo-advisors. They range a lot in their services, their strategies, whether they are totally digital or whether they also offer access to human financial coaches or planners. Their fees are different from fee free to higher fee levels, but typically they're all lower fee than you would pay at a traditional financial advisor. And Jeff, the reason that I really started researching them in 2015 was I thought they were such a smart and easy way for investors to get started. And all you have to do is transfer money in, you set up your you answer the questions, you set up an automatic transfer into that account, and then they invest for you for the long term.
No, that makes a lot of sense. And you talked about there being different, many of them having different services like access to human advisors or to people that can kind of, I guess, look over your shoulder a little bit. And they have different strategies. But I was curious though, and you mentioned 2015. I'm thinking robos have been around maybe for 15-ish years, but really in the
Yeah,
last
yeah,
5 years, I don't know. There's been an evolution, I guess. And
absolutely. Yeah.
I was
And
just
they,
curious if you could comment on that. Like, how have you seen sort of robo-advisors get better, perhaps, at what they
yeah,
do?
they started in about 2010 with um, Betterment, Wealthfront, and Personal Capital, which has since been bought out by Empower.
Right.
And they started out very, very simple. Subsequently, many different iterations have evolved, more services, more options. Wealthfront in particular remains pretty much all digital, and it was kind of designed for the Silicon Valley and the Bay Area techie. But I personally like Wealthfront an awful lot because they offer customization as well as their set portfolios.
Right.
So almost all robo advisors will give you a mix of stock and bond investment funds. And the percentages that are invested in bonds versus stocks are typically aligned with how much risk you can handle. Those that can handle more risk or who might be younger would have an allocation that would hold more stocks. Well, what Wealthfront has done is they've added in another option. So if you're a little bit more advanced or sophisticated, you might want to choose some of your additional funds to add into your portfolio. And then all the robo advisors do what is called rebalancing, or they take your original preferences and they make sure that when stocks outperform and they are on a roll, then they will sell some of those and increase your bond allocation, which what it does is it minimizes the volatility of your investment portfolio. So in terms of the evolution, the question you asked, that's kind of Wealthfront. Betterment has added in access to financial advisors.
Right.
They have two plans. One is all digital, where if you want to talk with a financial advisor, they give you access for certain fees. If you're wealthier and have a little more money, you can opt in for a higher level of service. You need $100,000 to start, but they have a plan where you have access to unlimited financial advisors. So those are just two examples of the initial robo advisors, how they have evolved over time.
So just kind of pulling on that thread a little bit, especially because you've mentioned, risk assessment and, answering a couple questions to drive, how the basically signaling or communicating to the robo advisor what a risk profile is, and basically that's used to effectively cascade, right, in terms of, well, with your risk profile, this is, the recommended portfolio of, stocks and bonds and things like that. So in my class, when we talk about this, and this is where for me it gets a little bit tricky, and I just want to get your thoughts on this. So the tricky thing for me is, because I'm looking at mostly 20-year-olds, right? These are undergraduates, sophomore, junior, senior types, right? So they're 19, 20, and 21. And, when I look at them, I go, in my mind, where I'm thinking is my mind's screaming at me to communicate to these students, which is you've got 40 plus years of runway. You should be, a 10 rated highest risk, risk assessment, because you'll be able to ride through several ups and downs in economies, recessions, expansions, etc. And with that kind of time frame, time is your friend, diversification is your friend. So you should be willing to take volatility risks, right? So that's like the sort of objective brain of mine. But then there's this other part of my brain which is going screaming at me, wait a second, if it's going to make them feel sick, if the market sells off 25% and they're going to sell at basically they're going to sell into a declining market because they get freaked out, well, that's horrible advice, right? So anyway, so I'm just curious if you have any kind of thoughts or advice on that, just in terms of how you've counseled, younger folks, especially in terms of both understanding the meaning of that risk assessment, but also, of course, being true to yourself.
That's a wonderful question, because what Jeff was referring to was stock market prices are very, very volatile, and they can go up in 1 year up to 20%, even more. But on the downside, there are years, 2008, the stock market dropped over 30%, I believe.
Yep.
There are years, periodically every 5 to 10 years, where you will see a huge drop in stocks. If your portfolio is 90% invested in the stock market and only 10% in bonds, you could experience a 30% drop in the value of your assets. Whereas if you had a more balance, because bonds also go down, but typically not as much as stocks. If you had a more balanced stock and bond, say 30% bonds, 70% stocks, the overall value of your investment portfolio during a market decline would be less than if you owned more stocks. So the common advice among many people counseling those of you that are in your 20s and 30s is bulk up on stocks, 90% plus. I'm here to say I'm a conservative investor. I've always been conservative. And that means I don't like to see a drop in my investments. I've seen many drops. I've been investing since the 1980s. So obviously, I've been through many drops. And I would like to say that I have never sold at the bottom, but always used a drop to invest more money, which is the smart way to build long-term wealth. On the other hand, I have never been 90% in all stocks, even when I was 25, even when I was 35. My daughter happens to be the same way. I haven't counseled her on her asset allocation. She has a robo-advisor and she took the quiz, and she's more conservatively invested as well. So the question is really, what is your comfort level?
Right.
And if you give up a little bit of upside return, if you are continually investing over time in a predominantly stock with some bonds in that portfolio, you're going to build wealth. You will build up to $1 million if you're starting in your 20s and 30s. And I'd like to give it a shout out to one of my favorite blog posts, which is historical stock and bond prices, because I show pictures of what the market has done since 1928. And then I segment it into different categories, different, 15, 50-year periods, so you know what to expect. Because I think, Jeff, if you have that understanding, you're more able to handle those declines when they come and not be scared if your assets go down and then unfortunately sell at the bottom, which is absolutely the worst thing to do.
Yeah. It's funny. One of the things it's really hard to do, but I talk to my students about, which is if you're in a long-term robo-advisor, and you're not going to need the money for whatever 10 years, why do you even check it? Why torture yourself, right? Like just set it and forget it and go on with your life. Now, of course, saying that and doing it are two different things because you like to see what your wealth position is, but maybe it's the advice is more don't drive yourself crazy because if you're in it for the long term, be a long-term investor, which means rarely selling or selling appropriately, whether it be tax-less harvesting and rebalancing, but not selling for fear. But don't drive yourself crazy. Like why, if the market's dropping, why would you do that to yourself? But anyway, I don't know.
No, I
I don't
agree
think
with
they
that.
actually listen to me, but
No,
it does make me think about it.
I agree with that as well. I think it is really, even on the upside or the downside, unless you need the money within the next year or two, and then if you do, it should not be in the stock market under any condition because you'll risk losing it or losing a portion. There's no need to look at the value of your accounts. And if you manage your own accounts and you don't choose a robo-advisor, well, then you still don't need to look at them if they're for long term because you'll rebalance once or twice a year and that's enough.
Right. Okay. So let's move into one of the things when we one of the first couple questions I asked you. You started talking a little bit about fees, or you mentioned fees as being one of the things. Of course, the criteria, and then there are a lot of different fee profiles. And one of the things I've noticed is there are a couple of robo-advisors that are fee free or have no AUM fee, versus other ones like Wealthfront and Betterment, I think are around about 25 basis points. But they do have these different fee or AUM fees. So I was just curious, oh, if you have a credible robo-advisor and one says they're free and the other one says they're not free, why wouldn't you use the one that's free? Do you talk a little bit about how their fees really work?
Sure. You're always, there's nothing free. You're always paying in some way or another. Robo-advisors make money in a variety of ways. They make money through their management fee, which you alluded to, which on average, many of them charge 25 basis points or a quarter of 1% on the value of your entire portfolio. That's pretty standard and that's a pretty reasonable fee. There are some robo advisors like Schwab and like SoFi Invest that do not charge management fees. One of my retirement accounts is in the Schwab robo-advisor. Now, the catch is, how do they do it? They require you to hold up to about 10% in cash, which means when the market is going up, you are sacrificing gains by holding that cash. Now, the cash is in a high yield account at Schwab, and Schwab got dinged by the SEC a couple of years ago because it was said they were not clear enough on the cash requirement and how they were getting paid. Schwab, for example, also includes many of their own proprietary exchange traded funds within their robo-advisor. But from an investor's viewpoint, most of those funds are pretty good and they're low management fee. So every fund, with the exception of Fidelity, who happens to have some totally fee-free mutual funds, index funds, every fund charges a small amount. Every index fund, exchange traded fund charges a small management fee. And that is apart from the fee that you pay to a robo-advisor company. So back to your question is, are you really paying? Well, sure. Let's use Schwab for an example. The money market fund is their money market fund. When they have your cash there, they can lend it out to other people. They're making money on that. They're making money also on their ETFs or exchange traded funds that are in that account, in your
Right.
robo-advisor account. Now, I'm fine with that. I like cash. I'm a conservative investor. I have a lot of cash in my overall portfolio. That's that's fine with me. For more aggressive investors, it's not going to work.
Yeah.
But you're always paying.
Yeah, the thing I struggle with the cash thing is it for me, I think of cash, I think of liquidity, right? In other
Mhm.
words, if something happens to me, I need to raise cash. Either there's some bad thing, so I need cash in my life, like, my car breaks down or, fire, whatever it is, but I need cash and I need it quick. Or an opportunity comes up, right? Like, oh, great, there's this new thing that investment that I want to invest into. But either way, to me, liquidity is what cash is all about. So the thing that drives me crazy about Schwab's strategy is that it's wrapped into the overall robo-advisor. I can't withdraw that 10%.
No, you can't.
Right?
And you have to be comfortable with that. Some people
Right.
are
And
not. But
well,
see,
yeah,
Jeff, what I look at cash under many circumstances, not when interest rates were like zero,
right,
which was, a couple of years ago, but in many circumstances, cash gives you the cash in Schwab is in a high yield money market account. So
right,
you're getting today about 4.5% on that cash. It's
right,
not that different from holding a bond.
right.
And it does provide a ballast when the stock market falls. Your cash allocation is not going to drop, it's going to remain the same.
Good.
But it is a definite personal opinion. I know many people are uncomfortable with that, and
Right.
for them, Schwab is not a good choice.
Yeah. Yeah. Well, well, I mean, I don't know much about the settlement, but I certainly love the idea of just making sure it's clear, right? And so people can make their
Absolutely.
choice. And
And
if, so that's good.
I knew it all along, but
Right.
obviously, most investors are not me. They're not
Right.
portfolio managers. They don't read the fine print. They don't understand everything. And that was the cause of the suit.
Right.
And Schwab made it right. So,
That's
you
good.
know, I think
Yeah.
it's good. But Jeff, I also want to tout another robo advisor, which I think has really come together for small investors as well as for beginner investors, and that's Fidelity Go. They
Hmm.
have transitioned to where the first $25,000 that you invest with them does not charge, there's no charge for a management fee. Now,
Brilliant.
after that, you do pay 0.35%, which is a little higher than both Wealthfront and Betterment and some of the others, but you get unlimited access to financial coaches, which I think is wonderful for
Right.
someone who is going to use that opportunity to discuss their financial and investment questions.
Yeah. No, I'm actually a pretty big fan of that. I also am a Fidelity Go client, and if I understand it correctly, so if you think about like Wealthfront and Betterment, right, they're charged 25 basis points, but you still get charged the back end fees, right, of the ETFs or mutual funds they buy. So maybe that's an additional 5 or 10% or 5 or 10 basis points.
It averages out probably 5 to 7 basis
5 to 7.
Yeah,
So,
because
but
they all use low fee funds.
right. But what I understand, and I'm not sure if this is still true, but when I researched it, this is what I came to understand is that basically Fidelity waives the back end fees of its funds that it's using within the Fidelity Go. And it only uses Fidelity funds. So there's a little bit of home cooking there, but the Fidelity fund set is so vast, right? I mean, to me, if you're saying Fidelity funds, you're pretty much saying the market, right? In terms of the kind of funds that they have at their disposal. So anyway, so for me, I kind of did the math on that. I was like, 35 basis points, if they're waiving those back end fees, is pretty close to what the other robos are doing.
You know, I'm well aware that Fidelity Flex mutual funds, which are a new class of mutual funds at Fidelity that came out a couple years ago, and they have no management expense ratios.
Right.
I was not aware that if they have other Fidelity funds in their robo-advisor, they're waiving the management fees. I
Okay.
don't know if that's accurate or not, so
Okay.
I can't address that issue.
Okay. Well, it's what I read probably a year or two ago when I set it up. So, I will say for me, that was true when I did it, but time changes, but who knows? Okay. Well, good. No, that was super helpful. Now, you mentioned another um no management fee robo-advisor. So there's Schwab, and then who was the other one?
SoFi is another one, and
SoFi.
they also provide half-hour appointments included in their robo-advisor, which I believe they call SoFi Automated Investing. They also give you the opportunity to sign up for half-hour meetings with financial advisors, which I think can be really, really helpful.
Right.
So
Okay.
that's a big draw.
Yes. So I was wondering, you know, just talking a little bit about the technology and especially artificial intelligence. And to me, this is a question I feel like if I ask 10 people, I get 10 slightly different answers. So I'm really curious, Barbara, if you have a perspective on this. Which is what I understand is in some cases, some people say that robo-advisors absolutely use artificial intelligence and there's some AI in what they do, but others will say, it's not really artificial intelligence. Yes, they're algorithms, but they're really rule sets that are managed by people and that are really doing what a good portfolio manager would do, like rebalancing or tax loss harvesting. But those things are really not really forms of artificial intelligence. So anyway, I don't know if you have a perspective on that technology and kind of how the robos go about doing what they do.
Well, I think it's a good question. And I have delved into robo-advisors in a very intense way from 2015 through about 2023. Okay, so within the past year, I have spent less time researching robo-advisor backend. So
Okay.
I cannot address what they have done in the last year, which I believe also corresponds with the sea change in AI. I mean, AI has exploded over the last year to 18 months.
Right.
Before that time, they used computer algorithms, which are computer programs that are programmed to buy and sell securities based on how the computer program is trained. And like you said, it's not going to be, it's based on what is called modern portfolio theory in almost all cases, although there are a couple of robo advisors. I believe Zacks and T. Rowe Price have more actively managed robo advisors that do not rely as much on the historical modern portfolio theory, which, we don't need to bore your listeners with that now. But all I can say is up to 2023, my experience was they were driven by algorithms that incorporated historical information to help determine the appropriate asset allocations and did the rebalancing for the platform.
Wow. Okay. No, that that makes a lot of sense. And I hear what you're saying in the last year of the explosion, and especially, of course, chat GPT and the chat technologies or the GPT technologies. So that for sure, but it is interesting how there does seem like there's a big change going on. But let me uh, and we're kind of coming to the bottom of the half hour, so to speak. And this has been just a wonderful conversation, been so helpful. But I did before we wrap up our conversation, I want to put you a little bit on the spot. So you mentioned, I believe, that there's about 25 or so major robo-advisors in the country, and perhaps, of course, at least as many minor ones. But if you were going to think about, again, beginning investing, but thinking about in terms of if you were going to give a short list, what you'd say is, hey, if you were considering, if not telling them which one to do, but if there was a short list of them that they want to make sure that they check out, which ones would those be? And then on the flip side of that, if there were ones, and you don't need to say who these are if you'd rather not, but if there was either robos that they should avoid, or at least tips about what to look for, like red flags, so to speak, in a robo, what might that be?
Sure. I think fees are really important because they add up over time. They compound and they add up, and a fee takes away from the money from your money that being invested in the financial markets. So number one, I would probably not go with any robo-advisor that charges more than 0.35%. I don't care if you're a beginner or not. I think you can get a very solid robo-advisor, and the majority of them are very good. I really would say when you talk about, are there some you'd avoid? Probably not. I think in general, the only ones I would avoid are the ones that are higher priced. If I were a beginner, I would say I like having some sort of access to a financial advisor. And
Right.
even at Wealthfront, and this is a little known secret of Wealthfront, that they don't advertise financial advisors. And it's kind of tricky to get through to their customer service advisors. But
Right.
when you do get through to them, they are licensed financial planners, every
Right.
one of them. So you're not going to have really easy access to them. But if you have a question or two, you can absolutely even get help at Wealthfront. So for
Right.
beginners, I would say a couple of things to look for. Low fees, some sort of way to get some financial advisor help. Now, SigFig is another robo-advisor. I believe they charge 0.25 or 25% basis, 25 basis points, and they have financial advisors for everyone. And at SigFig, you can leave your investments if you already have an account. I believe it's Fidelity, and I'm not sure if it's Schwab or not. But if you already have an investment account set up, they manage it for you. They don't require you to transfer your
Right.
assets to their platform. So I think that's good too. But I wouldn't
Okay.
obsess over it.
Got it.
I would say if you're a beginner, it's better not to worry, not be concerned about am I choosing the right one or the
Right.
wrong one. On my
Yeah.
website, I have a lot of reviews. I have one video, which is best robo-advisor for beginners. I have a robo-advisor for wealthy, a video, robo-advisors for wealthy people, and just specific reviews on a lot of individual platforms.
So one of the interesting things that I have not heard you talk about, which I find really interesting, and actually I would agree with that you're not really talking about, is performance, right? In other words, traditionally, when human advisors are measured, they're measured their performance against some relative benchmark, right? And that's a big deal. And you haven't really brought that up at all, and it wasn't mentioned as one of the criteria. And like I said, I would tend to agree with that because if you have a long-term strategy and you're using diversified funds, you really wouldn't expect them to, you wouldn't expect performance necessarily to be a big driver. You'd expect it to be generally average. But anyway, I didn't know if you wanted to kind of comment on that. It was just really
Absolutely.
interesting.
People worry a lot about performance. Number one fact is that in any given year, the overall market, which means most of the companies in the US would be represented by an investment portfolio of the Standard and Poor's 500 or the total stock market. And those investments are called like an index fund. And the research has shown time and time again that investing in the market typically surpasses the returns of active fund management. So let me repeat that really slowly for you guys who are striving to get these great returns. The returns of the market have been pretty great over time, and trying to beat the market is very, very difficult. Most robo-advisors know that, and that is why they invest in these unmanaged index funds that track different segments of the investment market. So their performances are going to vary, not so much based on, oh, robo-advisor A is better, robo-advisor B is better. No, they will vary based on the percentages of assets you have in specific stocks versus bonds. So if stocks return 20% one year and you have 90% in your stock account, your performance is going to be better than the guy or gal who only has 60% invested in stocks. What is going to impact performance is lower fees equal better performance. Passively managed funds outperform actively managed funds. And don't worry about your returns. Once you're in a robo-advisor, your returns will likely mirror those of the market. And trying to jump around and find the best performers, you can do that on your own. If you want to fool around in the market, take 5% of the money you have to invest and do whatever you want with it. Buy crypto, try and find the winning stock, whatever. You may hit a home run or you might strike out. It's not going to kill you.
Right. Oh, that is wonderful, Barbara. I was going to ask you to summarize our discussion as we come to the end of our interview, and I think you just did it. I mean that what a great way to wrap up. That set of the advice you just gave, I think is amazing, and right on point. So thank you very much. And Barbara, Personal Finance Reimagined, we're really focused on personal finance and decision making, right? In terms of really helping people to think about creating a consistent, repeatable decision process, really with financial decisions, whether it be around a robo-advisor or being around buying their house, buying their car, getting their retirement set up, but really helping them with a decision process that they can use then for those important financial decisions. So thank you so much for joining us today. It's really been a pleasure having you on.
It was so fun for me, and I love talking about investing, robo-advisors. And for any of you out there, if you want a free investing micro book or a book about how we increased our retirement funds over 900%, and side note, this wasn't quick, it was over decades, just pop on over to my website, Barbara Friedberg Personal Finance, and you can sign up there. Thanks for having me, Jeff. It was a pleasure.
Very nice. Well, have a great day. Take care.
Thank you.